Hello, welcome to Strictly Money. I'm Saijal Patel. With inflation at a 40-year high and stock markets declining, many retirees are increasingly worried about the impact the current economic environment will have on their standard of living. Because not only are higher prices eroding their purchasing power, their savings are depleting at a faster rate. And let's face it, for most seniors, returning back to the workforce is just not an option. Joining me now to discuss how to overcome inflation and longevity risk is Fraser Stark. He's the president of the Longevity Retirement Platform at Purpose Investments, and he joins me now. Hi, Fraser. Great to have you back on.
Yeah, hi, Saijal. Great to be back on the show.
You know, Fraser, I was reading a recent stat or a statistic that some 77% of Canadians between ages 55 and 69 are worried about their financial health. And most don't think that the current government retirement benefits, things like, CPP, OAS, are providing enough income for them. Probably doesn't surprise you.
It doesn't surprise me at all. I think inflation is the concept on everyone's lips these days. And if you think about the impact it has on a retired person, it's very different than on someone who's still working. So someone who's still working, much of the impact of inflation is offset by wage inflation. Not in perfect connection, but wages tend to move up in inflationary environments. But if your working years are behind you, you're living off your assets. And especially in the current environment where inflation is up significantly, and yet markets and portfolios are down, it's a really tough combination. It erodes people's purchasing power, as you said, quite significantly. So it's a very unique challenge for people in retirement.
Fraser, do you think that they should be worried about inflation? I mean, I guess it depends on your thoughts on how long inflation will stay, or whether this is permanently baked in. And I know it's in our faces, but do you think that's where they should be really focusing on, or do you think that there's longer term structural issues that they need to be thinking about?
Yeah, I think people do need to think about inflation a lot, and it's always hard to predict how long it's going to last for, right? The current inflation is being driven by supply chain issues, as we're all well aware, and when those will be remedied is not clear. They're driven by industrial effects coming out of China, the conflict between Russia and Ukraine causing food prices and energy prices to rise. So it's really hard to know when this is going to correct. And so for a retiree who's perhaps in their 60s or 70s, they have an uncertain amount of time remaining they need their assets to last for. And the combination, layering all of these uncertainties on top of each other, there's market uncertainty, there's uncertainty about their own lifespan and their health and spending needs associated with that. And now to layer on this idea that we don't know if inflation is going to stay around 8% or slowly start to revert back to a more typical 2 or 3%, it creates a lot of worry. And as we know, worry can be paralyzing to people. And unfortunately, what a lot of people do is they don't spend and they don't live their retirement dreams the way we hope they would.
No, yeah, absolutely. And what's really interesting, though, Fraser, is that previously a lot of retirees have been forced into the stock market. I mean, we've seen this just to try to earn a decent return because they were getting nothing in bonds or GICs. With interest rates starting to go up, do you feel like there's a bit of a bright spot, like where we could see a little bit of balance?
Yeah, it's certainly helpful that the risk-free rate, the yields essentially have risen, right? It gives people an opportunity to generate income without taking risk. And I think that's helpful as a portion of someone's retirement strategy. When rates were so low, you effectively couldn't generate much return without taking on risk. And so a lot of people shifted away from the traditional 60-40 or whatever their portfolio allocation was. And they were rewarded for it over the last period of time, with markets rising as quickly as they were. But as they correct, it becomes challenging. So I think we will see people moving back into some of those more either guaranteed or just low risk investments.
Do you have a sense, Fraser, of how pension funds are doing now with rates going up?
Well, it's certainly helpful. I don't have firsthand information about the funding levels at pension funds, but I think the higher rate environment is likely helpful to their situation for sure.
Okay.
But of course, with the current fixed income portfolios that they have, they've taken a hit. Depending on the duration of those investments, they've certainly taken a hit recently. So forward looking, it's a good picture, but the present, it can be more challenged.
Yeah, we only have about 20 seconds left. I want to get your thoughts on annuities. Are they coming back?
Well, the rates are
popularity?
certainly rising a little bit. Annuities have always made sense as a great way to address longevity risk, and we can talk about that more in a moment. They still have their structural issues though, and the lack of redeemability makes them unattractive. And because they're guaranteed, they won't go down. They also won't go up. So as an inflation hedge, they're not a very good vehicle.
Welcome back. Fraser, we were talking about annuities before the break. Given that rates are coming up, do you think there is a better case for them now?
There is. I mean, certainly someone who's seeking income in retirement and looking for that assurance that they won't outspend their retirement savings and that will last as long as they do. Annuities are a powerful vehicle to do that. There are, of course, trade-offs with everything. And so the trade-off for that guaranteed income for the rest of your life is that it won't go down, but it also won't go up. And so tying it back to inflation, it's a challenging environment where an annuity can only be a part of a strategy, and in fact, it's not going to be part of everyone's portfolio. Many people turn away from annuities because of the irrevocability of it. You are losing access to those assets, and there's no guarantee that if you pass away on the earlier side, your estate will even be made whole for the investment that you've made. So annuities are powerful, but have trade-offs that not everyone appreciates.
Yeah. Well, let's talk about the fund that you guys launched at Purpose. I mean, last year around this time, you launched the Longevity Pension Fund, and you came on the show in November to talk about it. How has it done, and what learnings, I guess, have you and the team taken away from it?
Yeah, that's great. Thanks for asking about that. Just as a recap, the fund is the first income for life mutual fund anywhere in the world, not just in Canada. So a truly made in Canada innovation here. It will pay income as long as each investor is alive. And so in many respects, it acts like a defined benefit pension plan or an annuity. And there's a redeemability to it. So at any time, an investor can choose to redeem their units for the lesser of the current fund value, its NAV, or unpaid capital, which is the amount they put in less the cumulative distributions received. The fund is doing phenomenally well, and I think markets have taken a real turn since I came on the show back in November, and I think it's highlighted the power of the fund's approach to portfolio construction, and so that highly diversified, both in terms of global diversification as well as asset classes, the use of a hedging strategy to ensure that when markets do correct, there's protection there, and that the fund doesn't decline as much as the markets at large. And so the fund has done incredibly well. I mean, we've made a lot of progress working with dealers to put it on the platform. The fund is now available to many Canadians in defined contribution pension plans, which is really powerful. So it's helping people accumulate for retirement, knowing that they now have income for life once they turn 65.
Yeah, I think we have an asset allocation chart that we can bring up to show the breakdown of it. Have you had to make changes to this?
No major changes, because we set out deliberately with a very conservative approach. The objective of the fund is to generate modest returns with minimal volatility. And so, we didn't know that this market shift was coming, but it was certainly a possibility. And markets have corrected quite significantly over the past 2 or 3 months. And the fund has performed extremely well. So, a slice of the fund is in alternative assets, real assets like real estate, precious metals, base metals like copper and steel, energy, and agricultural commodities. And that portion of the fund has lifted through this new inflationary period and performed the exact role that it was put there to create. And so if we look at the fund, we're approaching the fund's first anniversary next week. And since inception, the fund is only down 2.4% in an environment where a lot of our peer funds that are designed to provide income for people in retirement are down significantly more than that. And I think everyone's aware of the impact on both fixed income funds as well as equity funds. So we're very pleased with how the fund has performed given the challenging market environment around us.
So for someone who's interested in looking at this and think, okay, I can either go the mutual fund route, or I can go the annuity route, or I can look at this fund. What are some of the considerations? What are the pros? We got about a minute till the break.
Yeah. I think I've touched on annuities a moment ago. So the trade-offs there, that idea of guaranteed income and longevity risk pooling. What the longevity pension fund allows an investor to do is to have that longevity risk protection so that even if they turn out to be someone who lives longer than expected, they won't run out of funds. And yet they're still benefiting from being in the market, which over the long term, we know generates higher returns than taking safer investments that are guaranteed. And so it really is that hybrid between the two in a mutual fund structure. And ultimately, what it allows someone to do is spend more of the allocation they put into this fund. They're able to spend more each year, which is really powerful for many people.
Okay. And then we'll talk a little bit about the distributions because I want you to explain that. But we're going to take a quick break and then we'll continue this conversation. We'll be right back. Let's talk about the distributions and what investors can expect because it does fluctuate. My understanding is that people are grouped into cohorts. So, can you explain that and what people can expect?
Yeah, that's right. So investors are grouped into cohorts, and that's where the risk pooling is happening. Cohorts are based on birth year, and so we group people by 3 birth years. 1945 to 47 is cohort 1, 48 to 50 is cohort 2, and so on. And each of those cohorts, as you pointed out, is paying a distribution level that will evolve over time. That's the nature of a dynamic fund like this. And so, we can't know exactly how they're going to evolve over time, but we've done a tremendous amount of work over the past number of months working with LifeWorks to prepare an income policy and an evaluation of how investors can expect under different market conditions those distributions to evolve over time. So the way that we will adjust the distributions and are adjusting the distributions is similar to how a defined benefit pension plan looks at its funding level. So we think about the assets in the fund and the liabilities, the future payments that fund is expected to make, and determines, how are we funded? Are we at the funding level? Are we above it, or are we below it? And every year, the fund will reset its distribution level to achieve at least 100% funding, if not more. Now, as we evaluate that over, we've looked at 2,000 economic scenarios in over a 35 to 40 year period. And the good news is that the fund is expected to increase distributions over time. There are years when it goes up, years when it goes down as we look forward. But over time, investors can expect more than that initial 6.15% for people at retirement age. So when we look at it over a 20-year period, the average that investors can expect is 7.1%. And if you look at it over a 35-year period, the average is 8.2%. So that idea that this fund has an inflationary component to it, or that it raises rates over time, plays out in the modeling work that we've done.
You just touched on the longevity risk pooling, and I don't think our viewers necessarily understand what that means. But that's the benefit of doing this, right? And that's what makes it different from a regular mutual fund. Can you, Fraser, can you explain that concept?
Yeah, absolutely. So, longevity risk pooling is just the idea that some of us are going to live average, some are going to live shorter, and some are going to live longer. And there's, quite a distribution around those numbers. The average that a 65-year-old today can expect to live is about 87 or 88. However, there's a huge range of possibilities for any individual. Mm-hmm. Now, if we need to protect that risk that we might live to be 107, it would cause us to spend very conservatively. We're trying to make that nest egg we have as we enter retirement last a very long time. But that's likely to leave a lot more assets when we pass away than might be optimal. So by pooling risk and having everyone paid out from the fund as long as they're alive, it effectively allows people to spend with confidence, knowing that even if they're one of the lucky ones and live a very long time, they will have that income. And that longevity risk pooling is created by the redemption structure. So as I said, when someone redeems, they're receiving back their unpaid capital. They're made whole for that investment, or NAV in cases where it's
but not
lower.
Necessarily the earnings because of that.
That's right. The returns that have been generated above and beyond that are staying in the pool for the others. And so it's the only fund really that allows investors to benefit both from market returns as well as longevity credits that are flowing from people exiting the fund. So it actually has a dual source of income for the members of the fund.
How does protect itself from massive redemptions, right? Unlikely to happen, but is that something you obviously have to consider? And do you need a certain number of people to make this longevity risk pooling work?
Yeah, the good news on the number of people you need is it's actually surprisingly small to pool risk effectively. It's really only around 100 to 150 people per
Okay.
cohort, at which point you've effectively managed that risk. And when you think about redemptions, because they're actually beneficial to the remaining members of the fund, there's no harm. You know, if this fund were to fill with members and then they were to all exit either voluntarily or by passing away, you know, earlier than expected, that's actually beneficial to the remaining members. So in no way is this fund reliant on people staying in it. And in fact, if you think about it, the greater risk to the fund's rising distribution probability would be if people lived a lot longer. If everyone who buys into the fund lives to be in their 90s, the fund will not be able to raise distribution rates, to that level.
Yeah.
And we've modeled all of this. We look at, our assumptions around mortality are very conservative in a
Okay.
number of ways, but we've also modeled, what happens if people do live a year or two longer on average,
Yeah.
which we know the fund is quite resilient.
Welcome back. Fraser, on your website, on Purpose's website, I read an article of, one of the most important things that a retiree can do is have a proper retirement plan in place to combat inflation, which in fact, very few people do. It's certainly something I stress all the time. As we discussed, there's just so many variables that you have to think about, right? Can you talk about some of the examples of how this can help?
Yeah, of course. I think having a plan that looks at a wide variety of possible outcomes is the most important thing. So we've talked earlier in the program about the uncertainty that people face around what markets are going to do, what inflation will do, and critically, how long they will live. And so developing a plan that you're able to pressure test and make different assumptions about what happens if markets don't rise as they have been for a little bit. What happens if inflation holds at 8%? For a few years and everything becomes 25 to 30% more expensive. And what happens if I live a longer time? So, not only should people have a plan, but the plan should actually acknowledge the degrees of uncertainty and ensure that there's great outcomes that support the retirement that you're hoping for, regardless of which of those things play out. In addition to a plan, the only other thing I'd add is just finding a way to ensure that you're removing risk where you can, whether that's an inflationary sleeve in your portfolio or longevity risk pooling. I think those should be part of the plan. It's not enough just to write down a plan that says I'll keep doing what I'm doing.
How would you rate Canada's preparedness for a longevity risk? And maybe the second part of this is what do we need to see? Like where are the opportunities to fix any gaps?
Yeah, we're lucky to be in Canada. I think we do have, good government programs that many other countries don't have, and so we do start from a reasonable position. That said, those programs are not going to cover, everyone's needs, and I think a lot of people wake up to that as they enter retirement and look at the numbers and realize how expensive life is today, and realize that there's a critical component to preparing yourself for this. Our government is working on new legislation, things like VPLAs that can be part of a defined contribution
And that's variable pension.
That's right. It's the idea of a dynamic pension pool. It's
Yeah.
essentially what we've created in a mutual fund, but the government
Okay.
is legislating to enable those to go into defined contribution plans, which is powerful. Advanced life deferred annuities. So the idea of being able to buy an annuity that kicks in later in life than our current ones do. These are important tools. What we'd love to see is the government playing a role in educating Canadians on the importance of this, so that people do develop plans and understand where the risks lie, and also just keeping up with the innovation. So we've created an innovative fund. It's important that the government frameworks around taxation, around regulation, that they accommodate new innovation. And that's how the Canadian government can support this, where Canadians take charge of their own financial future, which is ultimately what the government wants us to do.
Yeah. I was reading somewhere where, CPP, OAS, it only makes up for the average person, about 40% of the income that they need. So they do need to think about that. Have you seen other countries, or have you been able to lift from other countries that have innovative solutions?
Yeah, there's great things happening around the world in this, slowly but accelerating. The Australians have copied things that Canada's been doing for several
I've heard
decades
that,
and
yeah.
are implementing inside their superannuation funds, which is great to see. And there's elements of what they're doing that we've adapted into. We launched Longevity Pension Fund at exactly the same time as some of those programs went live in Australia. And now what's happening is the US is looking to Canada. There've been a number of articles written in US press, both in Forbes as well as some trade-specific journals, really almost envious of what we've got in Canada. So it's great to see countries learning from each other and trying to improve upon what each has. There is a growing tide of awareness around the world about the magnitude of this problem, how people are spending more time in retirement and frankly are not prepared.
We only have about 30 seconds left. Would Purpose look at expanding into some of those regions like the US and bring some of these solutions there? And is it easy to do? I know there's different regulations.
Yeah, nothing's easy to do. We'd love to take this globally. This is innovation that deserves to be available to people around the world. We'd also love to do more innovation in Canada. We think of longevity as a retirement platform, not just the longevity pension fund. We're trying to figure out how do we help Canadians unlock the equity in their homes. Many families at retirement are quite wealthy in terms of the equity in their home, but may not have a lot of investable assets.
Okay.
So stay tuned for more innovation there.
Sounds great. We'll love to have you back on. Thanks, Fraser.
Thanks, Saijal.
Fraser Stark of Purpose Investments. Well, that's it for this show. Thanks for watching. We'll see you next time.